We will see when we have the data and the numbers, because we are really data dependent and we try to assess the situation based on figures, on data, on facts. We don't like to, operate on the basis of hearsay, assumption here, prices increases there. What is true, though, is that we have been revising upward many of our projections in the last 3 quarters. So things have picked up faster, and that is true for growth, that is true for inflation, and that is true for employment. So in a way, it's a package of good news, because it means that our economies are responding, jobs are being created again, the service activities, which were completely down for so long, are now, coming back in full swing. So all that is good, but of course it induces frictions and those bottlenecks or those supply chains that have been disrupted because of the pandemic, and where reinitiating the machine is taking time.
Yesterday the Fed had an all-important meeting, and it's clear that they are now on the trajectory of exiting their extraordinary measures. How much of a time lag do you think is there between the ECB and the Fed?
I have no idea. I have no idea, because we are operating with different programs. I mean, there is an element of tapering in the way they have structured their support package to the economy, whereas we are not in that situation. We are in the process of calibrating, and we have begun calibrating, okay? Because this is the fact for October, November, December, based on the latest decision that we made. But it's calibrating. It's making sure that we are procuring those favorable financing conditions and purchasing what is needed in order to provide that. The Fed is doing something slightly different, and I don't know whether they're doing it. My colleague and friend, Mr. Powell, just said that November might be the time, but it's fact dependent again.
He also was saying that he thinks that the Evergrande problematic or market turbulence is a purely Chinese problem. Do you think that as well? Because it has clearly spillover effects on the debt markets. For now, it's only Chinese, but the markets are very global.
We are looking at it. We are monitoring, and I had a briefing earlier on today, because I think that all financial markets are interconnected. And I have very vivid memories of latest stock market developments in China that had a bearing across the world. But in Europe and in the euro area in particular, direct exposure would be limited.
But are you concerned that, like, from the investors' sort of panic modus, which can clearly, easily spill over to other parts of the world as well, are you concerned that something like that could happen if the Chinese state really let them fall?
See, as I told you, for the moment, what we are seeing is China-centric impact and exposure, and I can't speak for the United States. I can say for Europe that its direct exposure is limited.